Welcome back. It's that time of your day where you sit back and I give you the good, the bad, and the ugly about financial markets. So go grab a beer and tell your wife she's got 15 minutes to get dinner ready, and let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and a very green day, which was quite literally the opposite of yesterday. The fundamentals that drove the market lower yesterday helped it rise today, and the majority of that move was actually led by Nvidia. The big tech stocks, the Magnificent Seven, Nvidia and semiconductors led the rally today, but we saw a huge move in infrastructure, Microsoft, Apple, Google, Meta. The worst performing sector here today was energy stocks. This was on the back of easing energy prices. The Middle Eastern tension is dissipating, and that did help the overall market today. Treasury yields were also very mixed. They actually did pull back as well, and those two dynamics, oil and treasury yields pulling back, meant stocks were actually very positive here today. Technology the leader, discretionary in second place, communication services in third place, all nearly up 1%, tech up 1.9%. And guys, comm services, discretionary technology, it's literally Meta, Google, Amazon, Tesla, Nvidia, Apple, Microsoft, right? It's the Magnificent Seven names. They led the rally today, but we also saw great performance in financials, healthcare, staples, real estate, industrials. Virtually every single sector was green today, except the materials and energy space. Anything that was related to mining or commodity prices down 0.4%, and energy down 2.54%. And it wasn't just large caps, it was a rally in smalls, medium, large, but particularly large growth up 1.97%, nearly 2% today. And it was really just a day for growth. Mid cap growth, small cap growth outperformed their counterparts. Large cap core did do well as well, but really it was a day for growth assets. But this was only in the US. Globally, stock markets around the world sank following some scary swings we saw in China as euphoria about possible stimulus gave way to disappointment. The market was expecting more stimulus announcements yesterday. In China, we didn't get it. Chinese stocks fell 9.4% broadly, and the same price action followed into Europe because as China goes, so too does Europe, and we saw much of the same in Canada as well as South America. The only green highlights were pretty much India, this southeast part of Asia, and then the US, which held firm in light of everything. And diving into the charts, very clear to see the S&P 500 up nearly a percentage point, just shy of 1%. The Nasdaq 100, the clear winner, up 1.55%. But the broader market actually didn't participate. So the RSP ever so slightly, yes, up 0.24%, but the IWM was virtually flat on the day. Mid caps virtually flat on the day. The S&P 600 slightly down. So it really was just a day for these large cap, mega cap growth names. If you were exposed to them, you did really well. And this was in the context of yields actually falling, commodities also falling. Gold and silver down 0.76%, silver down 3%. If we actually look at crude, down 4% for the day. The dollar remained flat, it's up 0.01%, and then bonds did gain. So yields falling actually didn't help higher beta, smaller cap names, mid cap names. It actually just helped the larger cap names. But we'll see if yields continue to fall, that's definitely going to be a benefit to small caps in aggregate. But looking at the charts more in depth, looking at the S&P 500, we did see some very clear things. You can't really see it right now, but if we actually just move this, the core resistance moved down from the 6,000 level to the 5850 level. The gamma flip and put support stayed where they are. And the S&P 500 is sort of just in this positive gamma area, like forming a base at this level. We're sort of just like trading sideways. And I think if we don't get a correction in price, we get a correction in time during October, and then go for the breakout to the upside, and then aim for 5850, 5900, 6000 into year end, assuming we do get that Santa rally that everybody does talk about in this November and December period, especially, the same rally that seasonality is pointing to that we get in the end of the year. So that could happen, but guys, we are in a very volatile week, a volatile month, and we could get that correction in price. So do be prepared for volatility, even though this is very mundane price action. Be prepared for the worst, and that way nothing ever shocks you. That being said, we are in positive gamma, and that means we buy dip, sell rips to the 58.50 area. Things were looking a bit shaky yesterday when we were a little bit in negative gamma, but we had a gap up and go pretty much near all-time highs in the S&P 500, and this price action looks constructive, especially year to date. Very, very constructive price action if you ask me. Very similar situation to the Nasdaq 100, but instead of forming a base at all-time highs, we're kind of putting in another higher low. We put a low here, another higher low, right? And that means we have to go take out this high, aim for the call resistance. We do that, trend continuation, at least this trend we've had right here, and then we can go target new all-time highs. We are in positive gamma. The trend looks very, very sound for these mega cap names. You know, they've kind of silently sort of just been going up. They had a violent pullback, but they've made higher highs, higher lows, and looking like the trend's about to continue to the upside. I really do think we go ahead and target these new all-time highs, especially into the middle of November into December. We can definitely see the mega cap names go ahead and take out those highs. Looking at the RTY, a little bit more muddy. You could say this is sort of like a higher low relative to these two lows right here, but I want to see more convincing upside price action, very similar to what we saw to the Nasdaq 100 today, before I can actually say this is a higher low. It is shaping up like that, especially in the positive gamma area. However, more convincing price action to the upside and take out some of these highs, then we can call this a higher low. Nonetheless, this does look like constructive price action because this is a higher low, this is a higher low, and these are 52-week equal highs we've made right here. Things looking good for the Russell 2000. We're just waiting for that next move up. You know, yields rallying didn't help small caps, but they are falling now, and we'll see what happens into the rest of the week and with the data at the end of this week. The RSP is exactly the same like the S&P 500. We're sort of just basing at this level. You want to buy at the 176 and 172 areas if we do pull back, but things are looking largely constructive in the markets right now. As long as the 10-year yield doesn't go any higher than like 4.15, I speak about that in the macro portion of the video. So go to that section and I talk about at what point does the 10-year yield start to affect equities, and it's about the 4.1, 4.15 level. So to actually see yields pull back, that's largely constructive. Anything below 4% is very, very good, but it's all dependent on the economic data, and the economic data right now is very, very strong. And that's really what's supporting stocks, particularly these large cap names, because these large cap names are highly correlated to the economy. The economy does well, these stocks do well. If the global economy does well, these stocks do very, very well. Where stuff like the IWM, it's actually more highly correlated to the cost of capital more than it is the economy. And if, you know, yields are rising, you're going to see sideways price action. And that's really what we've seen for the better part of, like, you know, 2 to 3 years. Pretty much sideways price action here. We had a little bit of an impulse move, then sideways price action, and then we had a little bit of an impulse move, I guess, here, and now we're seeing largely sideways price action as well. And this has correlated as yields have fallen, but we have seen a lot of volatility in the rate market nonetheless. Either way, guys, in the S&P 500, in the Nasdaq 100, and in the RTY, we are in positive gamma. So buy dips, sell rips, and aim to the core resistance. That is our targets into the September OPEX. Diving into sentiment, this is the Russell Contrarian Indicator. It essentially just measures investor sentiment from oversold to overbought on a panic to euphoria scale. A positive numeric score corresponds to signs of investor pessimism, while a negative score corresponds to a sign of investor optimism. And we're neither optimistic nor pessimistic, at least according to this scale right here. We're right in the middle between oversold, overbought, panic, and euphoria. And this is actually a really good timing tool. You can see in 2021, this is when equity markets topped. We went all the way to oversold territory, and you could see right here mid towards the end of 2023, we peaked out, and it was time to actually buy equities in this time. And right now, this indicator is signaling to us that whatever position you're in, you want to just hold, sit through the volatility, because we can see upswings, we can see downswings, but generally speaking, when we go from one extreme, we go to the other, like we did in 2018 to 2019, in 2020, and here in 2021 to 2022. So this indicator is telling us hold equities, more upside is likely, but this is more of a longer term trend indicator. looking at the year and now what we can expect in the next 1 to 3 months, especially when we've seen a year, January to September, rally greater than 10%, we can actually see quite a lot of volatility, particularly in the week we're in right now. October 7th to October 15th is a very negative week, seeing average returns negative 2.15%, median returns negative 1.53%. However, you want to buy the dip because generally end of October into December, those 8 strong weeks, often called the Santa rally, marks for a very strong 6.08% average return, 5.78% median return. The full period of October to December, we normally see average returns 2.83%, median returns 3.29%, 11 wins, 3 losses, very strong hit rate. And so you want to buy the dip, but be prepared for volatility. And there's 2 big reasons why we could actually see extended volatility in October. It has to do with the US election as well as yields. Now, the US election is pretty self-explanatory, but yields are doing things we never really thought they would in the middle or in the beginning of a cutting cycle. The 10-year yield has literally rallied from the 3.6% mark about 4 weeks ago to above the 4% level. This was at the start of today's trade, sitting at 4.006%. And according to data we get from 314 Research, the level where yields begin to impact stocks in a very material way is when yields move to the 80th percentile range, which is in this red zone that they've marked right here. When this indicator gets to above this threshold, it impacts stocks quite significantly. We could see last October, yields got into this level right here. And what did we see? Flat returns, and peak to trough, we actually saw declines. Then when yields actually pulled away from this level, we actually saw the end of year rally from October, November, December, and through the rest of 2024. Now we're not quite there, but yields are moving in that direction. And if we do get into this 80th percentile range, which would put the 10-year yield at about 4.15%, that's when yields are really going to start to impact stocks. We are already seeing yields sort of affect and rate sensitive sectors, but we do want to play the longer game. We do want to look at this as simply short-term weakness. We do know where interest rates are trending to. We are in the middle or at the start of a cutting cycle, and the shorter end of the curve will fall materially over the next 18 months. And as long as we don't get a recession, that's normally very good for stocks. When we avoid a recession, stocks can return 20 to 30% plus 12, 24, 36 months after we get the first rate cut. However, if we do enter a recession, things look very, very grim, and it doesn't look like we are going to enter a recession. And so you want to be positioned in equities, but where exactly do you want to be positioned? Well, a great place to start is look at what smart money are doing. And right now, throughout the month of September, BOFA's private clients position themselves heavily into REITs, financials, and utilities, as well as MLPs, which is pretty much energy. So what we're really seeing is that BOFA's private clients are positioning into the value segment of the market, as well as tech, a tiny bit in tech. And they've actually been selling staples, industrials, tips, as well as low volatility. So pretty much large cap stocks, anything that doesn't have a high beta, they've been getting out of. Tips, staples have a very low beta. Low volatility has a low beta. Industrials is a weird one because we've seen some massive earnings revisions in this sector. That's why BOFA's private clients actually sold industrials. History tells us you want to hold industrials into a cutting cycle, but the earnings doesn't support that picture at the moment. So moving out of low volatility in rate cuts, BOFA's private clients is moving into the value, high volatility, and probably smaller size mid-cap region. Stuff like REITs, financials, utilities, they're not necessarily large caps. While they are large cap stocks, they mostly fall in the mid cap and small cap components of the market. And we can see these are the parts of the market that are fairly valued and undervalued. Look at stuff like mid cap core, small cap core, as well as small cap value and large cap value to a degree. Financials, utilities all fall in the large cap value space. This is relatively undervalued to the rest of the large cap factor. And we can see the same with mid cap value, mid cap core, as well as small cap value and small cap core, and even small cap growth to a degree. degree. So it's very, very obvious to see the market is positioning itself into the value component as well as smaller size, higher volatility, and we're sort of moving away from some of the big names while still keeping exposure to technology, because you do want exposure to AI, semiconductors, and the tech space as a whole. And that's probably where you want to be. You want to add to smaller size, but you also do want to keep some high quality tech names because you want exposure to the massive secular trend of AI, which is going to be very, very big in the future. We may overshoot it in the short term, but in the long term, AI is definitely a place that's going to drive a lot of growth in the market, similar to what the internet did in the last 20 years. Diving into the macro, looking at inflation, we get the inflation figures this Thursday and Friday, CPI, PPI, and we're going to dive into expectations for this month, as well as Goldman's expectations for 2024, as well as 2025. And even in this Goldilocks economy, Goldman continue to see inflation to moderate. And while they do see a 2.6% headline CPI reading on Thursday, they actually see the same print into December 2024. So they don't see headline inflation decelerating, but into December 2025, they forecast a 2.1% headline CPI number, pretty much at the Fed's 2% target. However, where we haven't seen a decrease in headline figures, we see a decrease in core figures from August to December. Goldman forecast core CPI at 3.2% currently to 3% by December 2024, and by the end of 2025, they forecast a 2.3% print. And in light of everything, inflation continues to moderate, and this trend will continue into the end of the year, into 2025. And this is on the backdrop of a very, very robust labor market. Federal employment tax receipts clocked in for the first week of October at 10.5%. Very, very strong number. I do expect this number to pull back, but we should see a very strong print here in October, and this continues a very robust growth rate that we've seen for the last 12 months. The daily average at 3.8%, but once we get this ugly December figure out of the way, we should see this number skyrocket. And pretty much employment tax receipts is confirming the strong labor report that we got last week Friday. And when you look at something like the Perkins rule, which simply asks the question, are payrolls declining? It's not telling us that we're near a recession. This is a very good indicator in determining a recession, and we're not there yet, guys. So despite all the doom and gloom you hear on social media, a lot of indicators, stuff like federal tax receipts and the Perkins rule, is telling us that we're not near a recession, and you should expect better than expected outcomes in stuff like stocks. However, there are some risks right now, and Hurricane Helene has had some negative impacts on year-over-year total card spending growth, especially in the states of Florida, Georgia, North Carolina, and South Carolina, but this is likely to be temporary, so do expect a weaker retail sales report. However, if you look at the rest of the US, things rather look robust. It's just the impacted states that are seeing spending decline, and that's to be expected, but this should rebound very, very quickly in the months and weeks ahead. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Cheers.